And so we enter the age of the great mortgage crisis. Good afternoon, everybody. It's Rob Stewart with you. We are live. It's Thursday afternoon. It's swelteringly hot outside, and the temperature is reflecting what's happening in the mortgage market, the lending market, inflation. Everything feels hot. What doesn't feel hot is probably what's going to be going on with the housing market over the next 12 to 18 months. But we've got a lot to cover today. So welcome to the live stream if you're on the live. Welcome to the replay if you are on the replay. If you are new to the channel, hello. I go live every week and do a market narrative of what's going on, what news we've had over the past week, and crunch the numbers. And my aim for this live show is always to be able to look objectively at the data rather than looking at the sensationalist headlines, to enable us to be able to make better decisions, primarily for the property investment community. Okay, so I'm aware there'll probably be some homeowners now watching this with the titles, but primarily we're looking for property investors. But if you are a homeowner, we're going to go through all the same data that you're looking at, so that could be useful. First of all, as we come on, please make sure you can hear me, you can see me. If the audio is good, give me a thumbs up. If the video is good, give me a thumbs up. And if you are new to the channel, please hit that subscribe button and hit like, because it helps me grow the channel and get to the people that need to see it most. Lek, my man, very warm welcome to you on this live. So it seems every time I go live right now, there is another piece of major news that is causing chaos and shocks around the industry. This week was always going to be a busy news week. We have had the CPI print for May. We have had the UK Housing Price Index for April, which came out yesterday. And of course, a matter of minutes or hours ago, we had the latest MPC meeting where they have just announced a rise of interest rates to 5%. Okay, so I was talking about it last week, and a couple of weeks ago, I put a poll out. We were going to see if they were going to make the tough decisions and go to 5. Some people still thought we might stick. Others thought probably most likely was 4.75. I personally thought they would go to 5, especially after the inflation data that came out yesterday, and we've been proved correct. We're now at 5. So we will see what impact that is going to have on the property market. So without further ado, let's get cracking. And as we go on, if you have questions, if you're on the live stream or if you're watching on the replay, please put your questions in. I'll come back after every section and try and answer those questions for you. So I want this to be a conversation rather than just me lecturing forever. And if you're a regular subscriber, a regular watcher, we might be covering some of the stuff I talked about last week and the week before, but bear with me because there will be lots of new people on as well. So let's go into the CPI data that came out yesterday. All right, and unless you've had your head under a rock, the economists predicted we would have a drop, and we didn't. So that's every single time we've had a CPI print. I think this year they have been wrong. And what is starting to surprise me is why they are surprised that they're getting it wrong every single time. I would love to hear your thoughts on the inflation and what you believe is causing it, because generally inflation, the rapid inflation we have, or the high inflation we have, caused by a red hot economy, people spending a lot of stuff, there's a lot of narrative going, that's not the reason we have this inflation. There's lots of third-party factors that are out of our control: war in Ukraine, energy prices, food prices, fertilizer prices, all of those things that are third-party shocks that have fed into this. It's not actually people going out spending money which is causing inflation. So therefore, is raising interest rates the actual key to curb this inflation? Let's have a look at the actual data and see what we make of it. So if I zoom in here, okay, we can see we've had this nice little flat line between May and June, or May and June. Release is actually April and May, isn't it? So it's May data. And this is the thing that's caused people to have concern. This darker blue line under here, this is CPIH, which is with owner-occupied housing costs involved, actually gone slightly up. But the thing that is concerning most people, right, is this bit here, which continues to go up. This is our core inflation. So this is inflation when we strip out utilities, energy costs, and food, okay, which are the two things that are, sort of startlingly high right now. But the core inflation continues to go up. Let's have a look at the core inflation and see what's causing it. So if anybody goes through the CPI report, it kind of breaks down each of the little buckets, if you like, that go in to create this data. There are some things that are interesting. The biggest contributor, or the biggest rising contribution to this month's CPI print is recreation and culture. Interesting. Recreation and culture. I didn't even know what recreation and culture was in terms of a CPI bucket. But if we look at this and zoom in, right, our recreation and culture, sorry, let me just turn my pen back on, right, has zoomed up quite a lot. Now, recreation and culture are things like cinema tickets, going to music festivals, computer games, things like this. For me, all discretionary spending. So when people say we are purely being driven here by external influences, when we start to look at this, I start to question: is that a fair narrative? If the inflation, if we're spiking up for luxury or non-necessities, is there actually something else at play here? Are we out spending what we perceive to be more money? Wage growth is strong in nominal terms. We'll loop back to wage growth in a little bit and compare nominal to real terms. Have we had a shift in culture, in society, in psychology? Okay, are people just outspending, believing they are richer at the moment because of the wage growth? Do people have more disposable income for things like, for example, working at home, less travel, post-pandemic sort of trends, shift in trends? It's interesting. And by the way, I would just like to say, I don't have an answer to this. I'm not an economist. I'm an ex-fighter pilot turned property investor. So therefore, I don't have the answers. All I can do is look at the metrics, which is what we do here, look at the data and have a look at that. Interestingly, that has gone up an awful lot. If we look at food, now this is not part of core inflation, but I wanted to talk about it, right? Because we have now had a little dip in food, but I actually read the CPI report. And the CPI report said food inflation has eased in the month, which I think is crazy reporting from a, going to be objective government source. It's not eased, okay? It's still up at, 18% odd. That's not eased. That's still huge. It's still spiking and inflating massively. It's just the rate of inflation has marginally dropped. I think that's, sort of pretty lazy, not lazy. I think it's a narrative to try and, control people, to make people think it's not as bad as it is. Dropped marginally, but not really much. Food is still extremely high in terms of inflation. Something that has come down an awful lot, okay, to give balance to this argument, is fuel. Specifically motor fuel. Now, this is the inflation for transport and motor fuels. So that also includes things like air travel, railways. And actually, air travel has gone up quite a lot. I understand that the drop in, fuel has masked a lot of that, but that's come down. That's something to be, that's something good if we can find something in the silver lining. Okay, of course, energy should now be dropping out, or last month should have dropped out the inflation figures, that big spike at the beginning of last year. If we have a look, at the overall, this light blue line at the top here is goods. So goods are coming down in terms of rate of increase. They're still inflating at a very high rate, but the rate of inflation is coming down. What we're seeing now is services going up. Interestingly, services going up. So again, are we in this cycle of perception, public sentiment, companies' greed, profiteering, wages now filtering through, companies putting up wages, putting up prices. We get wage price spiral, price wage spiral. I don't want to go on too much about what causes one or the other. However, it appears that goods are coming down, services going up, and the net effect, right, is core inflation is continuing to rise. This is not great news. So, where does that leave us? MPC announcement today. Interest rates have gone up to 5%. I know a lot of people didn't think they would do it, didn't think they would have the balls to do it, but they have. The MPC have set interest rates to 5%. I would love to know your thoughts on this and what has happened. Okay, I'd love to know your thoughts on how this is going to affect everything, because there's now quite an aggressive rate rise. 4.5 to 5. Bearing in mind, it wasn't long ago people were talking about it petering out or topping out at 3.75. Is this the right call? Is this the wrong call? Is this the right mechanism? Not that they have any other mechanisms, of course. Is this the right mechanism to inflate the inflation that we're seeing right now? And what is going to be the knock-on effect to specifically housing? Because of course we're talking about it in terms of housing. Let's just have a see what we've got in terms of questions out there. Oh, Dino's put a thumbs up. Oh, sorry, Dino. I'll need to get rid of that. Stuart, half the country has some form of index-linked benefit, so when inflation is high, it's bound to get embedded. And I think we are seeing that right now. This inflation is stuck, it's embedded. Goods coming down, services going up. Look, this is not going away anywhere quickly. The only tool they have in their armory is to put interest rates up, but what is the effect going to be? Well, let's move on to the housing market, okay, and look at the April figures. And at the moment, team, I'm just going through the the data that's come out over the last 2 days. UK HPI, UK Housing Price Index for April figure showed seasonally adjusted 0.4% increase month on month. So that's April to March. So if we zoom in, we can see this little tiny uptick here. And of course, it's got the property bulls going, look, that's it, told you we were right. It's not going down any further. Let's just calm down on this a little bit. We're spring bounce. I said last week when I did my live last week, we were going to expect a little uptick. Okay, for a variety of reasons. One, because we've got the spring bounce. Although because of the lag, we might not be quite in spring bounce just yet with UK HPI. We saw the uptick in the Halifax HPI specifically, a little bounce a couple of months ago in the nationwide, and nothing goes down in a straight line. Oh, there it is, a straight line. So if I go over to 2008, okay, I'm going to show you something interesting in a sec. So if you hold on, I'm going to show you something very, very interesting in terms of comparing what happened in 2008 to now. But you can see again, nothing goes out in a straight line. There was an uptick there, okay, before we went down. Now, by the way, when I say this, I'm not saying that we are going to carry on going down. Everything I talk about is always a quantum of probabilities, okay? I've always been talking about 3 probabilities. We're in a little correction before going back to uptick is probability 1. Probability 2 is a longer, shallower correction, more 90s style. And probability 3 is a deeper V-shaped correction, more sort of 2008 style. And my personal prediction has always been a longer, shallower 90s style because the situation is more similar, not the same, but more similar to the 90s correction than to the 2008 correction. Don't forget, all markets, when we hit a peak, come down, bounce back up before capitulating. So the answer to this is we're not really going to know for another 6 to 12 months, where we really are because of the lag in the system. And this is one of the frustrating things about the property market is it doesn't crash, it slides. Let me just sort of click out of this a little bit. What happens with property is everything happens at a glacial pace, and we have leading indicators and lagging indicators, and we need to understand both and look at both. But looking at the HPIs, the house price indices, are lagging indicators, and the UK one, which is the overall, sort of default metric, lags the most. So we're looking at data that could be 3 to 6, maybe even more in some cases, in sort of arrears, if you like, out of date. And so it's very difficult to understand where we are now looking at that data. So for the lagging indicators, we're just going to have to suck it and see. Leading indicators are things like, well, I'll talk about the leading indicators in a sec. So we've got 3 main leading indicators that are going to tell us what's going to happen or give us a range of probabilities or tighten that range of probabilities down for the next sort of 6, 12, 18 months. Right. Ben, hey Ben, how you doing? Heard on the radio that our red hot labour market could be to blame. Without EU freedom of movement, we have no influx of workers to soften the labour market, hence spiralling wages. Labour market is red hot at the moment. I just wonder how long it's going to stay like that with interest rates carrying on as they are carrying on. I think what's interesting is actually it was 2021. There was the biggest influx of the biggest net migration figure that we've ever seen. It was 500,000 net migration. So I'm not quite sure about that. It's we've got getting no influx of labour. because we saw 500,000 2021. I've not seen the stats for 2022. I don't know if they're out yet, but that sort of bottleneck post COVID caused a lot of net migration in the year afterwards. So I'd imagine there'll still be a fair amount in 22. But that's interesting. But I know that we are in a red hot labour market, and there is a skills shortage, and there is a shortage of labour. I own, as well as doing property and investing in property, I own a scaffold business. And I can tell you right now, there is a critical shortage of skilled labour in the scaffolding market, and that is replicated around the construction industry, which does allow skilled tradesmen, and I'm talking specifically about the industries I'm in. I've got no idea about tech, I've got no idea about other services, things like that. But in construction, right, that labour is able to dictate what they get paid on a day rate, and we've seen a huge amount of expectation inflation in that. Now, this cannot go on forever, right? Especially if these interest rates carry on going up and we go into recession, at some point it's all going to start crumbling down, is my personal view. But that's interesting. We'll keep tabs on that, Ben, as we go forward. Okay, let's see, or let's have a quick look back at the HPI. Now, yes, look, we talked about a little uptick this year, this month. What is probably more relevant for us to look at is the year-on-year UK HPI, which dropped again. UK HPI, I think it's a 3.4%. This is not surprising at all if you look at the maths, of how year-on-year works, because the peak was last on UK ONS. It was actually November, I think the peak is, right? So that's going to carry on coming down for a while, unless we suddenly start going back up at rocket speed. But we are dropping, in terms of year on year. Here's the zero. So when we go below that, will be annual negative growth. I think it's unlikely we're not going to see that. But the question is how far it goes, right? If you see 2008, we went a long way down. How far are we going to go down? Are we going to go more like this? Are we going to come down a little bit more and resume uptrend? Or are we going to go like this? The answer is we don't know. We don't have the data. All we can do is carry on looking at this. Right, that's the stats. That's all the data that's come out over the last 2 days. It's been a lot, I'm aware of that. Keep the questions coming as we go, and I want to go into a little bit of a history lesson, because I think sometimes history gives us ideas about what is going on. Now, this graph these graphs are a little bit out of date now, but these graphs are house prices. I put real house prices on here for a reason, and UK versus UK interest rates. And I want to talk about the last two sort of boom bust cycles we had before this one. So if we zoom in, we've had a boom bust cycle, right? In the sort of early 80s, coming out the end of late 70s, 79, 80, interest rates, right, are extremely high. And if I just scroll down so you can see that more clearly. This is when, if I'll just zoom out, this is when the interest rates were at the highest. Now, I know a lot of people keep talking about, look, we are still, and if we follow this up here, we're now about there. We're still way below that. Fine. But our affordability, our debt to income ratio is greatly different. The amount of debt we hold is completely different. So we had sort of end of 1980, interest rate 17%. Forced the market down, as we came down. And then mid-80s, we came out of recession. We started going up, confidence grew. And even though interest rates, you can you can see here that interest rates are still high, but they're coming down. So they're trending down. And what happened was something called the Lawson boom. If you haven't heard about the Lawson boom, mid to end of the 80s, right? Confidence was high, economy was good. Lawson interest rates were reducing, and he actually cut income tax. So we had this sort of cocktail of factors that gave people more disposable income, which meant they could borrow more. A lot of people talk about supply demand. I'm going to put a pre-recorded video out tomorrow or Saturday talking about, is there actually a housing supply crisis or not? A lot of people say, right, it's supply demand is the big thing that pushes property price up. I'd disagree with that. I would say it's people's ability to afford to borrow or what they can borrow. So people could borrow more. They had more disposable income. Housing market boomed. Funny old thing. When it boomed, he had to stick interest rates back up again. So we're actually looking, interest rates did go up, but then came down again. But relative, when you look at debt to income serviceability, it was still affordable. And then what happened is inflation started going up. So end of the 80s, the economy started running away, inflation started going up, and Lawson had to whack the interest rates back up. Now, I don't know if this sounds familiar, and I want to say we are not in exactly the same situation now, but when you look at the circumstances, there are a lot of similarities between now and then. Okay, you've got a red-hot economy running away, you've got inflation going up, you've got relatively, if you look at here, relatively low interest rates compared to the last sort of 10 years or so. And to curb that inflation, he had to put interest rates up aggressively. What happened? We go into recession. And if you look at house prices on nominal terms, okay, the peak to trough was about 3 years. I think it bottomed out in 92 or 93. When you look at it in real terms, and I put it in real terms because we're investors, and so therefore actually the real price, i.e. inflation adjusted price of our assets are relevant. Because if we're looking at property as a store of wealth, if they are eroding below inflation, then they're being inflated away, right? They're being eroded away with inflation, different to being a homeowner. So the actual bottom of the market there was 96. So it's about 6 years peak to trough in terms of real house prices. Interest rates come down. People can afford more. We go into the late 90s, property market picks up, and then we go into the great housing boom. Now, the great housing boom of late 90s to sort of 2006, 2007, again, was very much fueled by increased confidence. Banks wanted to lend, and there was a difference between what happened in America and what happened here, but all the crisis from 2008 stemmed from America, but there was the same happening here. Banks were lending a lot more. Stress testing was low, ninja mortgages, no income, no job, no assets, mortgages were going out there, and house prices boomed. We go into the credit crunch, house prices drop very quickly, right? And to save that and bottom it out, interest rates are cut to, very, very cheap, historically cheap amounts. And we went into the era of cheap debt, where we've been ever since until about 6 to 12 months ago. So when we look at the housing market right now, there are similarities to that sort of early 80s. There are similarities to the 90s drop here, right? So 1990 down to, I think it actually peaks right at the end of 89, down to sort of 96 if you look at real house prices. So we can look at what happened with there, look at what happened there and try and make an assessment of where we are and look at the macroeconomic factors, right, to see what happens next. And that's what I want to do. Before I do, I want to talk about the gap, right? I'm just going to flick this on. So I talked about this last time. And this is sort of a little model I've come up with. And it's talking about, I want to try and demonstrate the lag that is happening here in between interest rates going up, people coming off fixed rate mortgages, and how that is affecting people not now, but in 6 months, 12 months, 18 months. And the longer this goes on, the more persistent inflation and the longer and higher interest rates carry on going up or stay high, the more this issue gets exacerbated. Okay, so if you look at this blue line is designed to represent the amount of people coming off their cheap fixed rate debt mortgages. I've been talking about it since February when I started this channel. This year, 1.6 million people coming off mortgages of 2% or low. That's a huge amount, right? That doesn't include the people last year who came off them. That doesn't include the people next year in 2024. But we are peaking sort of Q4 this year of people coming off. But that's sort of over 100,000. It's about 130,000 people every single month coming off cheap fixed rate debt of 2% or lower. Every time you put on the news right now, you see another article of somebody who's come off a cheap mortgage, they're now on high mortgages, and they have to cut back. They can't afford things. So this is compounding up, these amount of people, right? This red line is designed to reflect of people's affordability based on their mortgage payments. Let's just not even look at cost of living crisis. Let's not look at utilities going into the next winter, okay? Yes, they are coming down, but by how much? Not as much as we would want or expect. This gap is widening. More people coming off, less affordability, right? And the thing with interest rates going up is they take 12 to 18 months to filter through the system. So interest rate rises today to 5%. We're really going to see the effects of that in 12 to 18 months. Not now, 12 to 18 months. So right now, okay, we are seeing the effects. And when I say effects, of course, if people come off a fixed rate mortgage now, right, and they go on to a 6% mortgage, that's going to be felt now. But I mean the ripple effect of when that starts to actually bite will be 12 to 18 months. We'll look at arrears and repossessions in a little bit later on. The day that somebody goes from 2% to 6% does not mean they suddenly run out of money and get repossessed, right? So these things have a long tail effect, 12 to 18 months. And by the way, we're talking just about housing. Let's not forget businesses. I'll show you the chart of how the business or commercial property market has changed over the last 12 months in a sec. Businesses much more fragile or much more sensitive to interest rate rises, because many businesses that have debt, the debt will be variable rate, just the nature of businesses. Rather than fixed, which we have on mortgages, most business will be variable rate. That's going to have an immediate effect on businesses. Well, I say immediate, it's going to hurt them much more quickly. But again, it's going to take a while for that to filter through, especially if they've got cash reserves after COVID, furlough, C-bills, bounce back loans, all of that's, saving money by not having to send people all over the world, all of that sort of stuff. But it doesn't, this cash reserve doesn't last forever. Anyway, the point is on this, that this gap is widening. And I reckon we're about here. Okay, I reckon we're about here, which means it's going to carry on widening for another 6, 12, 18 months. And that's really important to understand, because even if interest rates top out, even if they don't go up again, which let's face it, they will do, right? I would be surprised if anything else happens, but interest rates continue to go up from here. I'll be pleasantly surprised, but I'll be surprised. But we do need to get rid of this inflation, right? So they're going to have to do what they can do. This gap gets wider. Just think about that when you're thinking about investing, when you're thinking about decisions. If you've got cash ready to go, you don't need to pounce too early right now. The opportunities will be there in 6, 12, 18 months. Trust me. Okay, so that's the gap. Let's go. Okay, what have I got next to talk about? Sorry, I know I'm going through quite a lot right now, but there's a lot to talk about. There's a huge amount we've got to get through. That's the gap. I also want to talk about media sentiment and the experts, because this is something, right, that moves markets. It doesn't move markets. Does it move markets? Yes, I think it does move markets, right? We have this perception thing where people make decisions based on what they're seeing in the media, right? They're not going out and doing all this research like we're doing, which I believe probably is why up to now, everything's been so hot. People continue spending. I've got to be honest, every time I go out into towns, cities, bars are packed, restaurants are packed. It doesn't feel like people are cutting back right now. Is that driven by media sentiment? I don't know. Is that driven by social media sentiment? Is it driven by just a complete difference in psychology of our culture now? Definitely doesn't feel like people are holding back despite cost of living crisis, despite interest rates rising. Could be wage growth. We've got that to talk about. We'll talk about that in a bit. So let's talk about what the experts are saying. Now, I want to be very objective here. I want to be very objective because I'm not calling either way, but I think it's fascinating when you look at how a lot of experts, influencers are still fighting it out online, right? Social media or otherwise, or mainstream media, talking about their internalized belief system, right? And pushing their sort of agenda into the world. And don't forget, everybody, including me, right, who is out there putting things out in the public forum has some form of agenda. I picked up on this. I don't know if anybody knows Russell Quirk, who's very outspoken property bull. Right, this article is from last year, 31st of August 2022. Russell Quirk calls out house price experts as idiots. People calling property market crashes, saying they're idiots. Okay, so it's not going to happen. And his statement was, and I believe it was November last year, he said in a year's time, property prices will still be higher year on year in November 23 to November 22. Interesting. Right, let's just hold that thought. The reason I've talked about this, I saw this yesterday. This came out yesterday. So this is Russell's opinion piece yesterday. House prices. If I was wrong, it ain't by much and not by nearly as much as the doomsters. So he's kind of saying that he was wrong, right? Dressing it up in a headline that if I was wrong, it wasn't by that much. And there's lots of other people who are more wrong than me. So I think it's interesting and by the way, I'm not focusing on Russell for any particular reason here. It's just something that I saw and I thought was interesting from a psychological point of view. When you look at the psychology of how we act and how we internalize in our belief systems and how difficult it is to actually change those belief systems, right, when we've internalized something, even in the face of data. Okay, so Russell here is kind of saying, yeah, I might have been a bit wrong, but not that wrong. If we go on and look at the article, he actually talks about how interest rates are still low compared to historical times, which is interesting because he doesn't talk about debt to serviceability ratios. at all, or debt serviceability, debt to income ratios. So there's no mention of debt to income ratios. So he's just used the same graph here that I pretty much used for exactly the opposite argument to the argument that I've just been talking about, which is over here, over here, debt to income is much lower, so therefore the effects of 17% interest rates are much lower than the effect of 5% interest rates on the current debt that we hold, which I think is interesting, right? He also talks about news reports. I just want to talk through some of these figures, so I'm going to fact check them in a sec. News reports quoting the typical UK fixed rate mortgage will now cost $2,900 more per year. Compared to what, right? There's no comparison there. It's a piece of selective data. That's £241 per month. Again, compared to what? Compared to last month, compared to 12 months ago? I don't know is the answer here. And he said, mortgage application stress tested to an interest rate of 5%. Well, we've just hit 5% base rate. So I believe the average fixed rate mortgage, 2-year fixed rate mortgage is now nudging 6%. So we're over the stress test amounts right now, okay? Also talks about wage growth. So wages are up by 7.2% year on year. This is now a far higher level than house price growth, which has slipped into, I've got to put the brackets in there, barely negative territory, according to the UK's most established index, the Halifax. And so whilst the cost of servicing a home loan may have increased by £200 a month or so to those who are not on a fixed rate deal, wages are up by nearly the same amount. I just want to talk about that statement, and this is why I do this show, because I think it's important to see through both sides of the argument, by the way, because there'll be plenty of people. I do also see there's commentators talking about 35% nominal drops, right, which is a huge amount. I do not believe that. I do not believe that that will happen. But also talking about saying wage growth is strong, and therefore the increase in wage growth more than matches the increase in mortgage payment serviceability, which I just think is an outright or just straight incorrect as a statement. And here's why I think that. It's to do with leverage. So, as a property investor, we often talk about leverage as one of the powerful mechanisms we have to grow a portfolio, to rapidly grow a portfolio using leverage with your own cash, other people's money. But leverage means by having a deposit, having a mortgage, or even buying something, adding value, refinancing it out. So we've not got a lot of original funds in, but then we have most of it on debt, right? Fantastic, because when the property market goes up, we're going to be benefiting from the overall increase, even though we're highly leveraged. We're using debt to leverage. Now, the problem is this works the other way around. So there's also negative things to leverage. So when that debt goes up, right, we're now having to service debt or service the debt on the entire amount. So I'm just going to do, I wanted to look at this. I'm going to just go back over here, and I want to run through some figures here so you know what I'm talking about. Okay, so I just wrote these out beforehand. I'm just going to write them down. Right now, according to the ONS, right, the average income, not including bonuses and things like that, is 31k a year. Okay, so if we take 31k, can you see that? Yeah, 31k average income, right? And at the moment, wage growth is 7%. 7%. So that would take us up to, and by the way, we're not actually there yet. We're actually looking at the previous. We should look at the previous, not the next, but I want to keep the maths easy. Would take us in a year to 33,170 as a average salary. Sorry, that all went very, very painty, right? Which is, I should probably use different colours, but I don't really have time. 2,170 increase over the year. Fine. Now, right now, average house is 280k. That's the average house price. And if we are leveraged with a 75% mortgage, and I know, by the way, this is not scientific. This is just me trying to put a concept in, right? A 78% mortgage on this, or 75% mortgage, means we'll have a mortgage of 214,500 as a mortgage. Okay. If we are paying 2% interest on that a year, we're paying 4,290. And if we're paying 6%, which is what the average 2-year fix is now pretty much at, we are paying 12870, okay, which is a difference of 8,580. So our mortgage payments have gone up by 8,580, but our 7% wage growth has gone up by 2,170. So if you take the 2,170 off that, Okay, it works out at plus 534 per month. So leverage doesn't help us, right? Leverage doesn't help us. It actually works against us in this scenario. And I've just done a very sort of broad brush analysis of those figures there. Of course, people might be on lower than 75% mortgages. We're talking averages here. We're talking averages. But this doesn't take into consideration two things. Number one, inflation adjusted wage growth, which we'll look at in a sec. And number two, the cost of living crisis, which we are still in. So when you start to add on utilities, everything out, food, right, that is spiking at 20%, a year right now, that makes our affordability even worse. When we then go and have a look at inflation adjusted, let me just zoom out, inflation adjusted wage growth, which is this bit here, right? So this is our nominal wage growth. This is our 7% a year. This is our real wages, right? Negative. This line here, that's the zero line. Right, so our real wages are in negative growth right now, inflation adjusted, which means we are actually getting poorer before we even look at having to service extra mortgage debt. So just to fact check that statement that was made in that article, right, when you run the maths, I do not agree with that statement in the slightest. Doesn't mean that we're suddenly going to crash, right? Doesn't mean the market's going to crash. I just want to caution people about what they read in the media without going through those figures. Okay, don't know if anybody's got any questions or thoughts on that. The other thing that I want to, you'll like this. So I want to see if I can find it. He talks about, there's a phrase somewhere about people talking about the property market crash. He said he sees no signs of the property market crash yet. Okay. No signs of the property market crash. Well, let's just have a look at that. If we go back to this ONS house price, average house price graph, here's where we are right now. Let's get this back on. Here's where we are right now, up at the top. This is where we were in 2008, in the last crash, which is widely regarded as sort of the deepest and quickest crash we've probably seen due to the credit crunch. Now, I was interested to compare where we are now, right, as in this bit here, to this bit here. Now, I'm not a graphic designer, okay? I'm not a graphic artist, so this is purely unscientific. But what I did was I got that graph, zoomed in on each bit, and I traced it. Right, I'll put this down here in a sec. I traced this graph onto a piece of paper on my computer screen, putting the peak of both markets next to each other to look at what's going on here. So, I don't know if we can see this. Let me see if I can zoom in on that. I don't know if I've got enough. Yeah, it's not going to let me. It's not going to let me zoom in, but I think you can see it anyway, Tim. This green line here is the market in 2006, 7, 8, and then dropping down. This red line is our market right now. Now, if we compare the peak of these and then look at the green line versus the red line, it's almost exactly the same as 2008 right now. Okay, that is not, there's no science behind that. I've just traced the two things at the same scale, just to clarify that, the same scale on the screen, and it's looking almost exactly the same. Now, I don't know if you can see it without zooming in. What I'll just do is see if I can lift it up a little bit. Okay, in 2008, we've got the green line has a little uptick here, which interestingly was April 2008. And you can see we've now had our little uptick here in April 2023. Sorry about the big splodge there. It makes it look like it's a bigger uptick. It's not a massive uptick. So the next few months, I think it's going to be quite interesting to see what happens with this. And if this red line follows the green line down, or, right, if it just shallows out and we go into a very gradual decline, which has always been my personal opinion of what's going to go on. I think it's unlikely that we're suddenly going to go back up like this, right? But let's come back to this in 6 months' time and see what happened to that red line. I might just hold on to that and come back to that red line. Any questions, team, as we progress through this? The reason I wanted to go through that, an expert opinion and mainstream, well, not even mainstream media, right? All media is I talked about it last time. Humans have this thing called cognitive, well, we've got two things, cognitive dissonance and cognitive shortcut making. So we're bombarded with so much information, right? We don't want to sit down and do all this crunching the data. You know, this has taken me most of today to put this together. Yes, I've been sitting outside and it's been nice doing it, but it's taken me a lot of time to crunch all of that. What we prefer to do as humans is scan headlines, right? Get the headlines and make our decisions based on that. It's called cognitive shortcuts. And if we have an internalization in our belief system, right, we're going to look for data that backs that internalized belief system. So if we think property prices are going to carry on going up, we're going to look for data that confirms that, right? Confirmation bias. So we're going to find an article like that and go, cool, look, Russell says it's going to carry on. Boom, perfect. Or we're the property bear and we think it's going to go down huge amounts, and we go out and find, you know, Moving Home with Charlie or something like that, where we talk about 35% nominal house price. Go, look, Charlie says it's going to happen. And that's how we make our decisions. This is dangerous. We need to understand what's actually going on. So what I want to do now is I want to talk about what are the things that would actually trigger a full-on crash, and are we in that sort of scenario? And you might have your own definition of crash. This is one of the issues talking about a property crash, is that everybody's got their own definitions of it. As I said last week or 2 weeks ago, a very well-respected property investor that I know, and who's also got his own big YouTube channel, defines a crash as 10% correction or 10% drop in a year. And I kind of broadly agree with that, because property is so glacial. 10% a year is a huge amount. So what would trigger that? What would trigger even more than that? Well, there's three main factors, okay, that really are going to push us into horrible territory here. One is rising negative equity. Second is rising debt service to income, i.e. affordability. And the third is unemployment. Okay, so I want to look at all three of these. And let's start with negative equity. So if we go back here and look at this graph again, there's not going to be, if we put this here, sorry, that's a bad line. Right now, there's not going to be a huge amount of people in negative equity. Okay, so maybe, and by the way, this is UK average. Regional is going to be different, right? This is a model. This is called a hedonic regression model. This is not actual house prices. This is a model where you put all the data in and crunches it and it comes up with this blue line. There may be some people now in negative equity. We might be starting to go into that phase, right? If the market here flatlines, we're not going to see a huge amount of negative equity. One of the issues with 2008 was loads of people went into negative equity, right? And, struggled to pay their mortgages, and of course the banks then repossessed. If we flatline, not a lot of people are going to go into that negative equity scenario. If we bounce up from here, nobody will be in negative equity, right? But if we come down, the further we come down, the more people come into negative equity. And this is why these things take such a long time to play out, okay? Because you've got compounding factors. And the answer is we don't know where this is going to go, right? We don't know. All we can do is look at the data. If we go back to the gap I talked about earlier, looking at that gap, the prediction will be, just purely from a mathematical point of view, that house prices will continue to go down. By how much, we don't know. Lots of, I would say, economists are talking about 10% from here now as a realistic. If we go down another 10% from here, 10%, we're at, what are we at? Sort of 290, 286. 10% from there is 28, right? Take 28 off, 260. We're at 260, right? We're all the way down here if we correct by 10%. That's kind of back to COVID pandemic. So everybody here is now in negative equity. So right now, negative equity, not a massive issue. 12 months in the future, negative equity might well be a big issue, okay? So negative equity is one thing that's going to trigger this. And by the way, there is something I want to point out here. I talk slightly interchangeably between nominal house prices, right? This is a nominal house price. This is the actual price you pay, versus real house prices, which are inflation adjusted house prices. As a homeowner, real house prices aren't that much of a factor, right? It's all relative. As an investor who uses property as a store of wealth, these are very, very applicable. And this is now way out of that, right? This is Q1 2023. We're now about to come to the end of Q2. So I can't imagine this is going to have gone up in Q2, bearing in mind inflation stays high and property is not going up. So this is probably going to come down even more. Very important to understand as an investor, if you hold something and we are in this sort of environment we are in now, that nominal price might not be doing that bad, but inflation adjusted, your equity is eroding. Yes, there's the case that your debt is also eroding, okay? But the value of wealth that you have in that property is eroding right now. How long that stays for, we don't know, but right now it's eroding, which is why we need to understand how we invest, right? Does it matter too much if we haven't got any of our original capital in? If we can do things like add value, recycle, it kind of bypasses a lot of this, because it's not just like you stick a load of your cash into something and it erodes away. If it's equity that you create out of thin air, less of an issue short term if that's eroding, if you've got your capital out and you're recycling. So, negative equity. Second thing I want to talk about is unemployment. Right now, we have a really tight labour market. Ben talked about it earlier. It's probably, right, the thing that is propping everything up at the moment is this tight labour market and, this weird dichotomy we have of strong wage growth, but actually lower than inflation. So even though it's strong wage growth on a nominal terms, we're actually getting poorer, but I'm not sure if people understand that, and therefore they're out spending because tight wage market, confidence is there at the moment. But what happens, right? What happens if this tips over the edge? This is from last month's, I haven't found this month's, this is from last month's projection from the government website, this fan diagram, which is showing just on average a trend up with unemployment. The trigger to fight inflation, the mechanism, the only mechanism they can use to fight inflation is to stick us into recession. Okay, confidence goes down, people spend less, or this is the broad brush theory, right? These are the models that people work to. You have to get us into a recession to get rid of this inflation. To get us into a recession, they're going to keep putting interest rates up. Businesses especially will have potentially a finite amount of time, right, that they have lots of cash reserves. I do think there's a lot of cash sloshing around still after COVID, which is, helpful in cushioning this a lot. But how long is that going to go on for with interest rates carrying on rising? If they continue to go up and they force us into recession, unemployment will go up. Potentially at the top of this fan chart here, we've got 7.5%. Conversely, they've also got, in the fan chart of just under 2%. So again, we don't know what's going to happen, but if this starts to uptick, right, this is a indicator, a leading indicator of what's going to go on with the property market. That's unemployment. At the moment, not an issue. This is the big issue, and we've got these three things. I don't know how we weight them, to be honest. If they're all going up equally, we've got people going to negative equity, we've got unemployment going up, and we've got affordability going down. That's going to do things. If we've got no unemployment, right, and very small amounts of people going to equity, but affordability is trashed, which is kind of what's happening right now. I don't know how that affects things in terms of a macro picture with the property market. But let's just have a look at this graph. This is a graph of the change in annual mortgage repayments as a share of income. Right, look at that spike. This spike is now bigger, right? Well, it says forecast. I don't know exactly where we are right now. Bigger than the biggest it's been in 1989. This is, this is just mortgage. This is before we go cost of living. So this is huge. If we look at our house price growth compared to wage growth, this is what I was talking about earlier. Look at, I think it's probably dipped down a little bit now because wage growth has gone up and house prices have dipped down. So it is coming down a little bit. But you can still see compared to, right, this is 1989 here when it hit a peak and then crashed. But we are, double that, almost double that right now. So affordability is an issue. So if you look at sort of a spreadsheet with red, green boxes, right, affordability definitely red, although again, people probably still have more money sloshing about because of all the free money that was given away and not having to travel and all that sort of stuff. But how quickly is that going to go through? Or, are we now entering this new phase of the mortgage shock where people are now really starting to feel it, really starting to bite, affordability is starting to kick in, right? The realization is starting to dawn on people about what is happening here, and they're going to have to start curbing back. Every day right now, I see articles of people going, my mortgage has gone up from £200 a month to £1,000 a month. I saw an article of a chap who sold part of his business 3 years ago, something like that, and bought a £7 million house in Surrey or Berkshire or something like that, and his mortgage payments had gone from £6,000 a month to £20,000 a month, and he was talking about having to sell or pull all his kids out of school. Probably not massive violins or anything like that going on, but the principle was massive increase, and the only reason he could get out of that was he completed the sale of his business. He was able to pay the mortgage down, pay the mortgage off. But this is now starting to get, let's go back to that gap. This is starting to happen more and more and more. Of course, we have the question of what will the government do to intervene? This is probably the biggest unknown in my mind, but we are coming up to an election in the next year, year and a half. Tories have always gone on housing, right? Hunter's come out and said no mortgage support, but that's government intervention. Okay, Sunak has also said no mortgage support. We're not going to help people pay their mortgages, and that's correct. They should absolutely not do that, because that's going to be inflationary in itself. I think it also penalises, people who do not have a mortgage. But what they are clearly doing is speaking to the banks and making sure the banks are doing what they can to stop this escalating down. So things like switching to interest-only mortgages from capital repayment to help people out. Banks to be more lenient in terms of, sort of covenants, in terms of when they start repossessing, all of that sort of stuff. It'll be interesting to see how that plays out over the next 12 months. The answer is we don't know. If we look at the Q1 mortgage arrears, nothing too shocking on this. Yes, they're up. I went through this about a month ago. This is now about to become out of date, and in a month or so we should get Q2. If we look at homeowner mortgages, this is homeowner mortgages here. They are starting to uptick, but they're still well below pre-pandemic levels. The thing that is noticeable and is upticking are the mortgage arrears for buy-to-let mortgages, is landlords. Now, this light blue line is people who are in the 2.5% to 5% arrears bracket. And when I crunch the maths on this, if you've just taken out a mortgage, to get to 2.5% arrears would be 5.5 months worth of missed payments. So again, this is such a lagging indicator, and why things take so long to get through, because it could be 12, 18 months from missing your first payment to being in a courtroom, right, for a repossession hearing. So there's so much lag in this system. So it's difficult to go off a lagging indicator like this, but I think it is very telling that the landlord arrears are going up, because landlords are definitely people who are going to be struggling, especially coming off fixed rates. The only thing they can do, right, is put up the rents, which of course compounds the cost of living crisis, or sell, which of course increases supply. But is this the opportunity for the smart property investor? Potentially. It's not going to be easy for the next couple of years, that's for sure. Not going to deny that. But if we can weather this storm for the next 2-3 years, okay, there is opportunity out there. There's huge amounts of opportunity. I put a video out last week about investing in commercial property. In fact, let me just sort of find that. Just want to find that graph quickly. Last graph before we wrap up and take any questions. This was 2022 for the commercial property market, right? Just look at those lines in terms of how they crashed in the second half of last year. Commercial property right now is extremely cheap compared to residential property. And when you combine that with the very generous permitted development system we have to bypass a lot of the planning rules, right, there is some significant opportunity for those who can go into an accumulation phase right now, right, in property, in preparation for the next cycle, if the next cycle comes along. And that's not guaranteed. And, there is part of me that thinks, is the property market fundamentally changing now? Or is that just like a, sorry, I'm just going to turn this light off. Is it actually going to fundamentally change, or are we just going to carry on in the boom-bust cycle, which is so indicative of Western culture? Biggest thing here is the UK has messed this up in terms of inflation. Bank of England have messed this up. We're in a bit of a sticky situation when you compare us to our peers. America, Germany, France are all doing better than we are. We're lagging behind. It's going to be deeper and more brutal in the UK for everybody. That's my opinion. I cannot see how we will not continue to slide down. It doesn't have to be massive. I'm not calling for a huge V crash, but property prices to slide down over the next 12 to 18, maybe, in terms of real prices, longer. That's it. That's where we are today. That's the impact. Next week, I'm going to do a video on investment strategies to beat inflation and beat these interest rates, which is all to do with investing in property cash flow multipliers. We'll define what a property cash flow multiplier is. There's always opportunities, and I can assure you that there are commercial landlords, private landlords who are willing to do deals, and that's going to compound over the next 6 to 12 months. There we go. That's me done for the day. Hope that was useful, team. Who have we got? Let's see what questions we've got. Jackson Landscaping. I think that's Shane, isn't it? How you doing, Shane? Do you think people should start worrying about a Black Swan event? Here's my view on worrying. A Black Swan event could happen at any time, Shane. The whole point of it being a Black Swan event is we don't know about it, so why worry? Yes, a Black Swan event could happen at any time. But if we are focusing on balance in our life, sort of happiness, contentment, which, by the way, I think is a very important part of this whole process. If you're investing or whatever like that, we can't anticipate. We can mitigate, but we can't anticipate. Right, mitigate rather than anticipate, two very fundamental differences. But I choose not to sit here and worry about things that might never happen. Sit in the present, look at the data we're looking at, and make smart decisions based on the trends that you're anticipating. Are we going to get it right all the time? No, because you're right, a black swan event might come. But if we are mitigated, right, that's fine. Let me give you an example. So right now I have one property in my portfolio, quite a large one, that is on a variable rate tracker, it's a variable rate mortgage. Okay, it's because I bought the company, not the property, and it's all the commercial finance get. So I'm acutely aware, right, of how businesses and commercial landlords are going to be feeling this much more acutely right now compared to residential who are not on fixed rate. That is hurting, but we've mitigated by having such a difference in cash flow versus mortgage payments. There is still, even now, 4 figures net cash flow from that particular property. Now, of course, something horrible could happen, right? We never know. But at the moment, it's mitigated because we've got the figures correct on that property. I want to give you another example. Another example is, in another business, a property holdings company I have, we took out quite a big portfolio mortgage, seven-figure amount on 2 large properties at the end of 2020 at about 3% fixed for 5 years. Okay, so over £1 million debt fixed at, I think it's 3.2 or something like that, fixed for the next 5 years. That was a fantastic decision in retrospect, but that ends at the end of 2025. Okay, now we're still 2 and a bit years away from that, but anticipating the future, do I think this is all going to go away in 2 and a bit years? No. So we go, right, how can we mitigate that risk, that shock that might happen in 2.5 years' time? The option we have, well, we've got several options. Number one, we can increase the cash flow. We invest in one of the properties and probably turn it into serviced rather than flats and increase the cash flow. Not my preference, because I'm more of a passive hand, sit back sort of investor. The other one is, can we sell one? And bearing in mind these are more complex properties. It's not residential. It's based on yield multipliers necessarily, rather than bricks and mortar. So are a bit more withholding. We've got long-term leases on them, which have been going up over the last couple of years, yearly sort of rent reviews. Do we sell one and use the proceeds of that to pay off the whole mortgage, which we can do? So then we've got one property rather than 2, but it's unencumbered. And is that something that we would want to do, over the next however long before, next cycle goes up, that is when, we look to maybe, refinance, re-leverage, go on the next sort of cycle of acquisitions, to then pay it back down before the next downturn. You see what I mean? So we've got different options there. All we can do is anticipate. Not anticipate. All we can do is mitigate. We can't anticipate. Okay? So that's my thought on that. Sam, let's put these questions on. If you buy an asset now that can cash flow with current rates, then life only gets easier in 5 years. I would have thought that is 100% correct. So actually, this is something that's going into my video. I probably should have said it. This is something that's going into my video for next week about how to invest in times like this. I don't want to, say we need to take advantage of the situation or add to the situation. On a little investor basis, we're not going to be contributing to UK inflation, right? Or the cost of living crisis. However, right now, interest rates are going up. To solve that problem, rents, as a landlord, rents go up. Now, obviously, rents can only go up to a certain amount, otherwise the whole thing pops because people can't afford it. But with wage growth, you can put rents up. I've got a lot of things on leases every year, and this is why, by the way, I prefer investing in higher density, larger units where we're putting in tenants that aren't residential tenants. So supported living companies, councils, things like that take even residential units on leases. We've got units that are on 1 unit, 13 flats, annual rent review. We just put that up 10%. Okay, we put it up 5% last year, so sort of February 2022, 5%, February 2023, 10%. I would imagine February 2023, 24, it's going to go up another, sort of 7 to 10%. And because you're working with organizations that understand this, it's just, look, this is what you have to do. Rents go up. At some point, interest rates will come down. Those rents are fixed. Those leases are fixed, right? They're unlikely to come down unless there's a massive change in supply demand, which I can't see happening. If all of a sudden millions of private rental properties flood the market, then yes, you're going to have to adjust your rent to cater for that. But it's very unlikely when you look at the amount of landlords leaving, right? There's not going to be a huge influx of people right now. So I can't see that supply demand for rental units suddenly flip-flopping. So you're absolutely right. Those rents stay high. So if you can make it, right, you've got your interest rates, you've got your rent, you can weather the storm for 2 or 3 years, right? You keep sticking, putting it up, and then interest rates will go, I'm not saying they're going to go down to 0.1 half, but even if they go down to, 4-3% in the future, you've then got a massive margin that's baked in there. Maybe that's the problem that causes inflation, that sort of stuff, by baking in increases, right? Who am I to say? But 100%, that's the right thing. Now, you've probably heard the phrase, observe the masses and do the opposite. Right now, everybody's exiting the market. Personally, I think that now is the time to accumulate, or start to accumulate, start the processes, pipelining process. I teach it with my clients or Property Cashflow Accelerator how to pipeline. Right, the best deals come in 3-6 months' time. Accumulate now for the next cycle up. Not guaranteed there will be a next cycle up, but if you do it in the right way, if you add value, create momentum and generate cash flow, it actually doesn't matter if it goes up or not, because you're getting a massive return on your capital after you recycle funds out. Hopefully that answers the question, Sam. Garth, how you doing, Garth? Good to see you. If you were a new property investor, would you wait in the near term to see market trajectory, or hold off to establish a clear position on the market in terms of interest rates and inflation? My answer to that, Garth, is I would never hold off if the deal is there, okay? If I was a developer or flipping, yes, right, I wouldn't be entering, unless it's really, really good, right? I wouldn't necessarily, and I'm not looking at things to flip right now, because market trajectory, it could flatline, it could come down slightly, and then you put that into your prices, it could go, if you look at the quantum of probabilities, it could drop 30%. So if you've baked in a 20-25% margin and it suddenly drops 30% in the next year, you're a little bit screwed. Of course, you probably have a plan B, which is refinance. But however, in terms of long-term strategy, right, if you find something that works, buy it. Obviously, the key thing to what I said there was that it works. And when I say works, it works in the current environment. I'm not saying go out and buy something that is a negative cash flower for you with high interest rates on the anticipation that interest rates will come down. I want to give you an example. I'm buying one right now. Middle of Chester, right? Mixed use building, high density building, very, very good deal on it from a retiring baby boomer landlord. And for me, that is a lifetime hold. And I don't particularly care about the capital price, change, because it's a cash flower. We're actually buying. I'm lucky enough to have been doing this for 15 years, so I have some resources. So we're buying that in cash. So actually, it doesn't matter too much. But when we bought it in cash, we've added the value, which will probably take 6 to 12 months. We'll then look at the situation and look to buy. So if you were working with investors who had cash, if you had your own cash, right? If you're doing creative deals, they're so, right, in the current market, the ability to do creative no money down deals are massive. We're just in negotiations on another commercial building down south, which will be with sort of an exchange subject to getting planning on it to turn it into a higher density sort of apart hotel style building. That sort of stuff becomes very exciting in a tricky market like this. What I wouldn't necessarily be doing is diving into buying things on bridging products, right, where you've got the potential for interest rates to go up, market, value to come down. You get stuck on a horrible high interest rate on a bridging loan with, 1-2% a month penalties. I wouldn't be advising that. But creative deals, anybody can be doing. If you've got cash, amazing. You borrow other people's cash, which there's still loads of cash hanging around. Yes. If the deal works, buy it. 100%. Hope that answers the question. Okay, team, we've been on for an hour. I don't know quite how we've managed that. I always think these sessions should be about 20 minutes long, and then we're an hour later after sort of rant a little bit about what's going on and all the the experts talking absolute hoop in terms of reality. But hey, look, maybe they are right and I'm just wrong. Maybe the maths is completely flawed. I don't know. All I know is that right now, when people say there's no crash, it's literally tracking exactly the same as 2008 right now. So I think that's quite interesting. Right, I'm going to hold it there, team, and let's see if the dust settles over the next week or so, and we'll get back together and rendezvous next week. Again, look, if you are new to the channel, you want to be notified, make sure you subscribe. I'm on a run into 1,000 subscribers right now after starting in March, so that'd be a big milestone for me. So if you do think there's some value in what we're talking about, I'd appreciate it. But otherwise, team, I will see you next week. Take care. Enjoy the sun.